Before you buy your next product, before you launch your next business, before you trust another success story on social media, you need to hear this. Most people look at a $100 product on a shelf and think the brand just made $100. They didn't. In fact, the number on that tag, it's a fiction. A carefully engineered illusion designed to make you feel like you understand commerce, while the people who actually run the world count their money in a language you were never taught. There is a hidden calculation, a margin gap, a system, and it separates the businesses that print generational wealth from the ones that collapse quietly after 18 months. Today, we're going behind the curtain. We're decoding the invisible math that retail giants, pharmaceutical empires, and institutional traders use to build billions. And by the end of this video, you'll never look at a price tag the same way again. Let's start with the number that changed how I see every business transaction. In professional commerce, the price a consumer sees, not a reality. It's theater. It's the number designed for you, the end consumer, the last person in a very long, very profitable chain. The people who actually build wealth, they operate on something called Here's how it works. When a major company, say a pharmaceutical giant or a tech hardware manufacturer, sets an MRP of $1,000, they are not pulling that number from thin air. They are building a web, a layered architecture of distributors, logistics networks, sales representatives, and retail partners, each one taking a slice. At the professional level, the standard deduction in high-volume industries is 10%. Take that $1,000 product, strip away the 15% margin. You're left with $850 as the trade price. That $150 gap, that is the battlefield. That is where market share is won and lost. That is the number that decides whether your company survives or gets swallowed by a competitor who understood it better. And here's the brutal truth most entrepreneurs never hear until it's too late. They plan for the $1,000. They only ever receive the $850. They build their cost structures, their team salaries, their expansion plans, all around a number that does not exist in the real transaction. And when the gap hits them, it doesn't feel like a margin problem. It feels like the market rejected them. It feels personal. It wasn't personal. It was math they ignored. But the 15% rule is just the entry point. Because once you understand margins, you start to see a bigger game being played, one that most people will spend their entire lives participating in without ever realizing it. Think about the institutions, the firms whose names you've heard in whispers: JP Morgan, Jane Street, Citadel. These aren't just banks, they are liquidity architects. They don't chase retail buyers. They don't compete for the $1,000 price tag. They position themselves inside the gap. Here's a real-world example. Look at the silver market. On the surface, silver is just a commodity, a shiny metal with industrial demand. But when you zoom out and look at lease rates, inventory levels, and supply chain pressure, especially during geopolitical shocks in the Middle East or energy crises, something fascinating happens. The trade price of the asset decouples from its perceived value. Supply drops, lease rates spike, and the institutional players, the ones who've been quietly accumulating positions, controlling flow, managing liquidity, they make their move before the retail market even processes what's happening. They're not reacting to the market. They are the market. And the mechanism they use, it's the same 15% logic, scaled to billions. They find the gap between what something is priced at and what it's worth in a constrained supply environment. Then they control the flow between those two numbers. This is not manipulation in the illegal sense. This is systems thinking at the highest level, and it's available to anyone willing to study it. Now, let's go somewhere most finance channels won't take you, inside the human mind. Because the 15% margin doesn't just exist in spreadsheets, it exists in psychology. Companies like Apple, Nike, and Amazon don't set their MRP based purely on cost plus accounting.
They engineer the price based on something called perceived value architecture. The price tag is not a reflection of cost. It's a signal to your brain about status, quality, and identity. When you see a $1,000 product, your brain doesn't calculate material costs. It calculates social meaning. And the company? They've already baked in the 15% trade margin, the distributor cut, the logistics overhead, and still landed at $1,000 because the psychological ceiling of what you will pay was tested, modeled, and optimized before the product ever hit the shelf.
This is why the wealthiest businesses in the world are not product companies. They are perception companies. They sell the gap between what something costs to produce and what the market believes it's worth. And that gap, that psychological margin, can be far wider than 15%. In luxury goods, it can be 300%. In software, thousands of percent. The 15% rule gives you the floor. Understanding psychology gives you the ceiling. So here's the question that actually matters. How do you use this? Because understanding the 15% rule isn't just academic, it's operational. Whether you're building a YouTube automation channel, a digital product business, or a physical goods brand, the same logic applies. Step 1. Know your trade price before you set your retail price. If you're selling a course, a product, or a service, build your entire cost structure around what you'll actually receive after platform fees, payment processing, and affiliate commissions. Never plan for the ceiling. Always plan for the floor. Step 2. Position yourself inside the gap. The most profitable businesses don't compete on price. They compete on positioning. Find the space between what something costs to deliver and what a specific audience will pay for the transformation it represents. That gap is your margin. Protect it. Step 3. Control the flow, not just the product. The institutions didn't get rich owning silver. They got rich controlling when, where, and to whom silver moved. In the digital economy, this translates to audience ownership. Email lists, community platforms, proprietary content ecosystems. If you control the flow of attention, you control the trade price of your content. Step 4. Stack your revenue model. A single income stream is an MRP with no margin. The businesses that survive build layered monetization. AdSense, sponsorships, affiliates, digital products, coaching. Each layer is a new trade channel. Each channel compounds your total yield. Here's what I want you to sit with. Every product you've ever bought, every brand you've ever admired, every billionaire you've ever followed on social media, they did not win because they worked harder than you. They won because they understood a system you weren't taught. The 15% gap is real. The institutional positioning is real. The psychology of perceived value is real. And none of it requires a hedge fund, a venture capital backer, or a family connection to use. It requires understanding. That's what this channel is about. Not surface-level finance content, not recycled motivational quotes about hustle. Real systems, real mechanisms. The invisible architecture of wealth, decoded, simplified, and handed to you in a format you can actually use. If that's the kind of content you want more of, the kind that makes you feel like you've been handed a key you didn't know existed, subscribe. Because what we're covering next is going to go even deeper. The game is being played whether you understand it or not. The only question is which side of the margin you want to be on.